Everything that I build around and our methodology is around some first principles, right? So a lot of techniques, why we do things, the tactics really is predicated on this. So the foundations I want to start with and share the foundations with all of you. Now, actually, we should just level set and make sure that we understand what the concept of a syndicate is, right? You can think of a syndicate lead, or one version. I like to describe syndicates as performing a market maker function. We sit in between two sets of stakeholders. On the one hand are investors or LPs. I'll use the term LPs to refer to investors, even though classically LP refers to an investor in a VC fund. Okay. But for our investor network, we are serving them with curated deal flow. We give our investors global scale deal sourcing. We do full diligence and package up data rooms. What our value proposition is to investors is to build their own portfolio. Outside of that, there is zero commitment to invest. We do not control dry powder. On the other hand, we serve startups who will talk about getting a clean line on the cap table and a substantial six-figure check, which is very nice because the syndicate tends to sit in between the 4 or 5-figure check from angels and then the 6-7-figure check from VCs. So it sits very nicely in that capital continuum. Now, what is really underlying the ability to write that 6-figure check in one line of the cap table is hundreds or thousands of pre-built investor relationships. This is the secret unlock for startups. It's not the capital, it's pre-built relationships, and we can bring this to bear for the startups that we choose to back. And I think if it's harnessed in the right way, a syndicate can be a really good expert network that can be value add to the startups as well, right? So that's another benefit. So the 4 first principles that we build around are these. The first one is proprietary networks. If you are building your own syndicate, the core value prop that you bring to investors is the relationship. So think of this as IP. So you really need to build that base and own that, because this is what is going to be your unlock to capital. Second, when working with investors, the currency is trust, not dollars and cents. I think if you approach investors and to see them as, hey, you're a walking ATM or a checkbook, right? Investors do sniff it out, they feel it, and you lose the engagement. So whatever you can do to preserve that trust is valuable. Next, I believe in building for scale, right? Scale means being able to scale capital. It means being able to de-risk the fundraise because you have enough investors on your side. However, if you're building for scale, you also need the right level of automation and communications to support that scale, because otherwise it doesn't work. You'll hit a bottleneck in getting deals done. And the final thing is know your metrics. My view of the way angel networks and syndicates operate today is that for the most part, we're operating in the dark. It's a bit throw paint on the wall approach and to see what works. I try to make a point to be able to measure as much as we can, and so that we know to guide our efforts and direct them into the right places. Okay, so I'll cover all of these 4 things at different points in this webinar series. Something I urge you all to think about when you're building syndicate is to think about trade-offs, right? In the end, it's about philosophical design, about how you want to operate. For every decision that you take, very often there is also a trade-off. So you want to be conscious about this. So let me touch on some of these things. The first one is deal volume. Now, if you're doing more deals, it basically means more diversification. You're getting more shots on the board, which basically improves the probability of finding a successful deal. However, the more deals you do, you are potentially straining investor trust at the limit. Imagine if you're doing 3-4 deals every single month. Right? Investors go, hey, are these guys serious? How much diligence are they doing? How good is the quality? The more deals you do, you're also depleting capital. As you grow your investor base, that capital pool will increase over time organically. But if you go too fast, you're also depleting it. I think doing multiple deals or too many deals creates a trade-off mentality in investors. They go, you know what, there's going to be a deal in another 2 weeks. I don't need to look at this one. So you run into that dynamic. It's going to impact average check size because investors are going to spread out their capital more. And if you're investing alongside in all of these deals, which philosophically you should to have skin in the game, you're straining your personal capital. The next one is the size of your investor network. The larger your investor network, there's a general correlation with your average raise. More numbers on your side also means predictability, reliability of capital. The average check size is also correlated with your economics, both on a cash and carried interest basis. However, the larger your investor network, it means more effort to acquire and manage that investor base. It's also going to take bandwidth away from doing deals. One of the innovations that we've cracked is basically how do we build and scale the investor base while not scaling the effort in an equivalent way, right? In fact, it's very de minimis. I think there's also a phase approach where in the initial build, you really have to focus on building up that investor base first, and then shift gears towards being an investor later. Next, average check size. This is something that I get asked. I don't think it's all that sound a question because you don't actually have a direct lever against investor check size. But assuming that you do, right? Just as a hypothetical, the larger your average check size, the easier it is to get deals done. It also means you need fewer investors to raise a given amount of capital. That all makes sense. However, the fewer investors that you have writing larger checks, it also means concentration risk. What if one investor is 25% of your raise? Right? That single investor could make or break your entire deal if you have a target allocation. Larger investors, in my experience, also have a bit of herd decision making. They tend to know each other, which means that they tend to invest as a group altogether or not, which exacerbates that concentration risk. The last one is your diligence bar. Right? The more diligence that you do, the higher quality it is. It's going to affect the deal success probability. It's a mechanism for preserving investor trust because investors will see the quality of the diligence that you do. It ends up also raising more capital. So that's the plus side. The downside is that the higher the bar, obviously the fewer deals that you do, which means less diversification. At the limit, you can be too inactive and then investors look like, okay, these guys are not doing anything. Okay, so I just want to illustrate, think about some of these considerations in your philosophical design, how you want to execute this, and be aware of the trade-offs.